All right, this is the end of chapter question. These are not illustrations. These are the end of chapter questions. All right, and I'm doing question number 4. I'm doing question number 4 from the end of chapter questions. Okay. A Limited purchased a machinery of rupees 100 crore on 1st of April 2011. All right, A Limited has purchased the plant and machinery for 100 crores on 1st April 2011. This is the cost, all right? This is not the carrying amount. This is the cost that they've provided because it's saying that we purchased for 100 crores. The machine has a useful life of 5 years. It has got zero residual value, all right? It has nil residual value. A Limited adopts straight line method of depreciation for depreciating the plant and machinery. Why are they giving us all this information? Because probably they're not actually giving us the carrying amount directly. In all the illustrations we did earlier, they gave us the carrying amount directly, whereas over here, they've given us the cost, they've given us residual value, and they've given us the life, and they're actually telling us that we have adopted straight line method of depreciation. All right, so they're telling us we've adopted straight line method of depreciation, and they're asking us to calculate the carrying amount. All right, implicitly, they're actually asking us to calculate the carrying amount ourselves. Following information has been provided on 31st of March 2012. All right, I purchased the machinery on 31st April 2011. 1 year later, on 31st of March 2012, I've got the following information. These are the estimated future cash flows. They've given the estimated future cash flows in crores. 2012-13, 13-14, 14-15, and 15-16. I am expecting cash flows of 15 crores, 30 crores, 40 crores, and 10 crores. Why do you think they've given us this? Because they want us to calculate the value in use. Remember, the value in use is by using the machinery, what are the cash flows that I'm going to generate from the machinery, discount them to today's terms, and that is going to be the value in use. It is the present value of the future cash flows expected to be derived from continuing use of the machine. What is the present value of the expected future cash flows to be generated from the continuing use of the machine? By using the machine, what I'm expected to generate in the form of cash flows. If you actually notice, the life of the asset was 5 years. 1 year has passed by. We're now standing on 31st of March 2012, which means 1 year has passed by. So the asset actually has only 4 years of life left. They have given us the cash flows for all the 4 years. They've given us the expected cash flows for all the 4 years. So we are actually required to take the present value of these cash flows to calculate the value in use. Discount rate, they've given us 10%. We are going to use this to discount the future cash flows. Fair value less cost to sell on 31st of March 2012 is rupees 70 crores. All right, they've given FV less CTD is 70 crores. Calculate impairment loss if any. Basically, first, they've not given us the carrying amount. Second, they've not given us the value in use. Third, we are being asked to calculate impairment loss if any. Let's start by calculating the carrying amount first, all right? Because we don't have the carrying amount, let's actually start by calculating the carrying amount itself. So step 1 is calculation of carrying amount. Cost was equal to rupees 100 crores. Salvage value was nil. Therefore, the depreciation would be rupees 100 crores less nil, cost less salvage value divided by useful life. All right, useful life, the question gave it as 5 years. Right, the depreciation formula as per SLM method is cost less salvage value divided by useful life. So the depreciation would be rupees 20 crore. All right, 1 year has passed by. WDV has it written down value or the carrying amount. Let me use the term carrying amount only. Carrying amount on 31st of March 2012. All right, 1 year has passed by. So carrying amount on 31st of March 2012 would be rupees 100 crores less rupees 20 crores, which is the depreciation for year 1. All right, I purchased the asset for 100 crores on 1st April 2011. I charge depreciation for 1 year of 20 crores, and therefore the carrying amount is equal to 80 crores. The carrying amount is equal to 80 crores. Next comes step 2, which is calculation of VIU. All right, so we've got year 1, 2, 3, 4. We have got 4 years. All right. Although the question has said 12, 13, 13, 14, 14, 15, and 15, 16. I'm calling them 1, 2, 3, and 4. Cash flows, what are given? 15, 30, 40, and 10. All right. 15, 30, 40, and 10 crores. Now, if you actually think of it, when a machine is being put to use, it would generate cash flows throughout the year. All right, you will sell the inventory throughout the year, and therefore you will actually receive cash flows throughout the year. But for the sake of simplicity, we assume that all these cash flows are collected at the end of each year. We actually assume that all these cash flows are collected at the end of each year. Therefore, we are required to next is we are required to now discount these cash flows, and we calculate the present value factor at 10%. All right, we are going to calculate the discount factor or the present value factor at 10%, which will be 0.9091, 0.8264, 0.7513, and I don't remember what the fourth factor is, so I'm just quickly doing it. It's 0.6830. And then we have discounted cash flow, which is the product of cash flow and the discount factor. The product of cash flow and the discount factor is the discounted cash flow. So it's going to be 13.64. I'm rounding everything to 2 decimals. 24.79 crores. 40 multiplied by 0.7513 is 30.05 crores. And 10 multiplied by 0.68 is 6.83 crores. The aggregate of this is 13.64 plus 24.79 plus 30.05 plus 6.83. That's equal to 75.31 crores. All right, it's equal to 75.31 crores. This represents the present value of the future cash flows that I am expected to receive from continuing use of the asset. VIU is defined as the present value of the future cash flows that are expected to be generated from the continuing use of asset. So if I use this machinery for the next 4 years, I am going to generate a benefit to me of 75.31 crores in present value terms. Step 3 would be calculation of recoverable amount. Now that we have VIU, we can actually calculate recoverable amount. Recoverable amount is the higher of value in use and FV less CTD. All right, VIU, we just calculated it as rupees 75.31 crores. And FV less CTD, I think it was given in the question as 70 crores. All right. So if I sell the asset today, I expect to generate net proceeds of rupees 70 crores. All right. So FV less CTD is rupees 70 crores. The higher of the two is going to be equal to VIU, and therefore recoverable amount is going to be equal to 75.31 crores. Now, if you think of it, this machinery is being reflected on the balance sheet at rupees 80 crores. This asset was existing on my balance sheet or was being reflected on my balance sheet at 80 crores. But the benefit that I expect to derive from the asset is only 75.31. So I'm overstating my assets to ensure that the balance sheet has a fair reporting, to ensure a true and correct reporting. We have to now charge impairment loss, which will be bringing down the asset value from 80 to 75.31. So therefore, impairment loss is going to be calculated as carrying amount less recoverable amount. Carrying amount is rupees 80 crores less rupees 75.31 crores, which would be equal to, I think, rupees 4.69 crores. All right, it will be 80 less 75.31. So impairment loss will be 4.69 crores. This impairment loss will be reflected in the statement of profit and loss as an expense, and the assets value, we are now bringing it down from 80 to 75.31. All right, so when I present the balance sheet finally, the asset will be reflected at 75.31 crores. All right, even if you credit accumulated impairment, just like how accumulated depreciation is shown as a reduction from the value of asset on the balance sheet, accumulated impairment will also be shown as a reduction from the carrying amount on the balance sheet. All right, so cost less accumulated depreciation less accumulated impairment will be reflected as a net amount on the balance sheet. Let's actually quickly see whether the answer that we've calculated is correct. All right, the value in use, we also got it as 75.31, and therefore we have 4.69 crores as the impairment loss that we have charged. All right, so 4.69 crores will be the impairment loss. This is the end of chapter questions, question number 4. All right, let's do illustration 3. Mass Limited gives the following estimates of cash flows relating to property, plant and equipment on 31st of March 2014. The following are the estimates of cash flows for as at 31st of March 2014. Discount rate is 15%. All right, they've given the discount rate as 15%. Since we're standing on 31st of March 2014, their projections start from 1415. They're starting from 1415 until 1819. All right, so we've got 5 years starting from 2014-15 until 2018-19. All right, so we are expected to generate this property, plant and equipment is expected to generate cash flow of 2000, 3000, 3000, 4000 and 2000 lakhs for the next 5 years. It's expected to generate cash flows for the next 5 years. And we have also been provided with residual value that is expected as at 31st of March 2019. So we are standing on 2014, 31st of March. We expect to use the asset for the next 5 years. At the end of fifth year, which is 2019, we expect to sell the asset in the market, and we believe that the asset will actually fetch 500 lakh rupees. All right. This is also going to be considered for VIU computation purposes. VIU is calculated as the present value of future cash flows expected to be generated from the asset. Now, we are going to generate these next 5 years of cash flows, but you're also going to generate any residual value. If you sell the asset on 31st of March 2019, 5 years later, you are actually going to receive 500 lakhs, and that will also be considered for VIU calculation. Let's continue reading the question. The property, plant and equipment was purchased on 2011. On 1st April 2011, it was purchased for 20,000 lakhs. So today is 31st of March 2014. The question is saying that 3 years ago, we purchased it for 20,000 lakhs. All right, we purchased it for 20,000 lakhs 3 years ago. 3 years have passed by because 2012, 13 and 14, and we are now standing on 31st of March 2014. Useful life at the time of purchase was 8 years. All right, it is making sense because at the time of purchase, useful life was 8 years. We used 3 years and therefore we have 5 years left, and therefore the question has given us projection only for the next 5 years. Out of the total life of 8 years, 3 years have passed by, and therefore we have projections for the next 5 years. Residual value that was estimated at the end of 8 years is rupees 500 lakhs. In fact, this is probably a repeat of the fact that is already given in the table, because residual value as at 31st of March 2019 is given as 500 lakhs, right? Therefore, this is information that is just a repeat. Residual value which is estimated at the end of 8 years is rupees 500 lakhs. Why are they giving you this? Remember, you should also consider residual value for depreciation purposes. All right, they've not given you the carrying amount. We are required to calculate the carrying amount, but to calculate carrying amount in depreciation formula, we are required to consider residual value as a deduction from cost. All right, fair value less cost to dispose is 10,000 lakhs. No calculation required. The best part of the question was it is giving you FV less CTD directly. Calculate the impairment loss, if any, on the property, plant and equipment. That is part 1. Also calculate the revised carrying amount. Revised carrying amount is basically the carrying amount after you charge impairment. All right. What is the revised carrying amount after you charge impairment, and the revised depreciation of the property, plant and equipment? We will see how we calculate all the 3 values. Let's start with calculating impairment loss first. For calculating impairment loss, we need step 1 as calculation of VIU, because we don't have VIU directly given. All right. So step 1 is going to be calculation of VIU. So we have cash year. We have got 5 years, year 1, 2, 3, 4, and 5. We've then got cash flows, which was 2000, 3000, 3000, 2000, 3000, 3000. Year 4 was 4000. And year 5, we had a cash flow of 2000, but we also expected to receive residual value of 500. Therefore, year 5, the cash flow will be total 2500. At the end of 5th year, I expect to receive 2500 lakhs, 2000 from the ongoing operations. And at the end of 5th year, I will also sell the asset. And therefore, I expect to receive 2500. All right, so we receive 2500. We calculate present value factor at 15%. The discount rate given is 15%. And then we have finally the discounted cash flow. The first year present value factor or the discount factor would be calculated as 1 divided by 1.15, which is equal to 0.8696. 1 divided by 1.15 is 0.8696. 1 divided by 1.15, the whole square, is 0.7561. All right. The third year discount factor would be calculated as 1 divided by 1.15, the whole cube, which is 1.6575. The fourth year is 1 divided by 1.15, the whole power 4, which is 0.5718. And the fifth year will be calculated as 1 divided by 1.15 whole power 5, which will be equal to 0.4972. All right. So we have discount rate given as 15%. Using the 15% discount rate, we've calculated the discount factors to be 0.8696, 0.7561, 0.6575, 0.5718, 0.4972. How did we calculate them? 1 divided by 1.15 is the first year discount factor. The second year discount factor is 1 divided by 1.15, the whole square. Third, fourth, and fifth, so on. Discounted cash flow is the product of cash flow and the discount factor. All right, discounted cash flow is the product of cash flow and discount factor, which is equal to 2000 into 0.8696, which will be 1739.2. Second year is 3000 into 0.7561, which is equal to 2268.3. Third year is 3000 into 0.6575, which is 1972.5. Fourth year is 4000 multiplied by 0.5718, which is 2287.2. And fifth year is 2500 into 0.4972, which is equal to 1243. The sum total of this is going to be the present value of the future cash flows expected to be generated from the asset. The sum is going to be the present value of the future cash flows expected to be generated from the asset, and that is going to be the VIU. That is equal to, I'm just writing 9510.20. All right. So the VIU is 9510.2 lakhs. Was it lakhs or was it crores? It's lakhs, right? Therefore, VIU is equal to rupees 9510.20 lakhs. Let's quickly check whether we have the same answer as that of the institute. Institute has got an answer of 9513, which is fine. They have used the discount factor only restricted to 3 decimals. You can also use that for examination purposes, but the VIU is going to be 9510.2 lakhs. Step number 2 is calculation of the carrying amount. All right. You could have done carrying amount first and then recoverable and then VIU as well. But I'm just doing carrying amount as the second step. All right, both of them are fine. The cost of asset on 1st April 2011 was rupees 20,000 lakhs. Okay, the cost was rupees 20,000 lakhs. Residual value, I'm just writing R, or let me write it in full. Residual value was estimated as rupees 500 lakhs and the life was estimated as 8 years, right? Useful life was estimated as 8 years. Therefore, depreciation per annum is going to be equal to cost less residual value . divided by life of the asset, which in this case is 20,000 lakhs less 500 lakhs, the whole divided by 8. Okay, so that's going to be 19,500 divided by 8, which is equal to 2,437.5 lakhs. It's 2,437.5 lakhs. All right, so the depreciation per annum that we originally calculated is 2,437.5. Carrying amount of the asset on 31st of March 2014, we purchased it on first April 2011. The carrying amount on 31st of March 2014 will be equal to rupees 20,000 lakhs less depreciation for 3 years. It will be equal to depreciation for 3 years. All right, so I'm multiplying the depreciation per annum by 3 years, which in this case comes out to 20,000 less 7,312.5. All right, so the final carrying amount turns out to be 12,687.5 lakhs. This is the value of the asset in my books of accounts as at date. All right, the property, plant and equipment has a carrying amount of 12,687.5. The historical cost was 20,000 lakhs. I charged a depreciation for 3 years of 7,312 and I have got a carrying amount of 12,687.5. All right, let's move to step number 3, which is calculation of recoverable amount. All right, we calculated VIU, but we still don't know what the recoverable amount actually is. So calculation of recoverable amount. Recoverable amount, same story again. It is the higher of value in use and fair value less CTD. Value in use we calculated in step 1 to be equal to rupees 9,510.20 lakhs. Fair value less CTD, I think, was given in the question as rupees 10,000 lakhs. Let's just quickly go and verify. It was given in the question as rupees 10,000 lakhs, right? Fair value less CTD is equal to 10,000 lakhs. Therefore, higher of value in use, higher of value in use and fair value less CTD in this case is equal to fair value less CTD, and therefore recoverable amount is going to be equal to rupees 10,000 lakhs. I have got an asset in my balance sheet at rupees 12,687, but the benefit that I expect to derive from the asset is only rupees 10,000 lakhs. Therefore, I'm required to bring down the asset value from 12,687 to 10,000 by recognizing an impairment loss of rupees 2,687. So step 4 is basically calculation of impairment loss. And this is equal to carrying amount less recoverable amount. Carrying amount is 12,687.5 less recoverable amount is equal to 10,000 lakhs. And that is equal to rupees 2,687.5 lakhs. So I'm charging an impairment loss of 2,687.5 lakhs. All right, 2,687.5 lakhs will appear as an expense in the statement of profit and loss. This is until calculation of impairment loss. The question also had few other bits. The question required us to calculate the revised carrying amount. What is the revised carrying amount and the revised depreciation? The question required us to calculate the revised carrying amount and the revised depreciation. The original carrying amount before we recognized any impairment was 12,687. The original carrying amount before we recognized impairment was 12,687.5 lakhs. After I charge an impairment, if you think of it, I'm charging an impairment of 2,687. So I'm crediting asset or I'm reducing the asset by 2,687. Therefore, the revised carrying amount will actually be equal to 12,687 less 2,687, and it will be equal to 10,000 lakhs itself, which is also equal to the recoverable amount. The revised carrying amount will actually by default be equal to the recoverable amount because we have charged an impairment loss. We charged an impairment loss in such a way that the asset value comes down to the recoverable amount. Therefore, the revised carrying amount is going to be equal to the recoverable amount. All right, revised carrying amount can be calculated revised carrying amount is equal to the original carrying amount less impairment loss, all right, which is equal to 12,687.5 less 2,687.5, which is equal to rupees 10,000 lakhs, which is also going to be equal to the recoverable amount because we have charged impairment loss in such a way that the assets value comes down to the recoverable amount. All right, we calculated the 2,687 in such a way that the assets value comes down to the recoverable amount, and therefore the revised carrying amount will by default be equal to the recoverable amount itself. Now comes the last step where the question required us to calculate the revised depreciation. Now we calculated the depreciation originally as 2,437.5 lakhs. We calculated the depreciation originally as 2,437. All right. But now we are now actually bringing down the asset value to 10,000 lakhs. We are bringing down the asset value to 10,000 lakhs, and therefore you cannot continue to charge depreciation for the next 5 years as of 2,437 because you're now changing the carrying amount of the asset. The depreciation going to be charged in future should also undergo a change. You cannot continue to depreciate it using the old values itself because the carrying amount is now being changed to 10,000 lakhs. You have to now calculate the revised depreciation on a prospective basis. We have to calculate the revised depreciation on a prospective basis, and we calculate the revised depreciation as the carrying amount less any residual value divided by the remaining useful life. The revised depreciation will be calculated as revised carrying amount less residual value. Please do not forget that residual value is required to be deducted for the purpose of calculating depreciation divided by remaining useful life. The denominator will not be 8 years, but it will be 5 years. All right, we will be dividing it by the remaining useful life. Revised carrying amount was rupees 10,000 lakhs. Less residual value was equal to 500 lakhs divided by remaining useful life of 5 years. That is equal to 9,500 divided by 5. That will turn out to be rupees 1,900 lakhs. All right. So the entity will be required to charge a depreciation of 1,900 lakhs for the next 5 years. It will charge depreciation for 1,900 lakhs in the next year. By that, the assets carrying amount will reduce from 10,000 to 8,100. Similarly, the next year, the year after that, it will be reducing from 8,100 to, let's say, about 6,200, if I'm right. It'll be about 6,200, and that way the assets carrying amount will keep reducing, and it won't go down to zero at the end of useful life. It will go down to 500 at the end of useful life. After 5 years are done, it will go down to 500 lakhs because that is the estimated residual value that we had kept. All right, we had estimated a residual value, and therefore the asset will go down to its estimated residual value of 500 lakh rupees. All right, we are required to charge a depreciation no longer of 2,400 lakhs, but we are only required to charge a depreciation of 1,900 lakhs starting from today, starting from the next year onwards. All right, so the revised depreciation is calculated as revised carrying amount less residual value divided by the remaining useful life. All right, originally we calculated the depreciation as cost less residual value divided by total life. Over here, because we are adjusting the depreciation on a prospective basis, we are going to calculate it as revised carrying amount after impairment loss less residual value divided by the remaining useful life. All right, the remaining useful life was 5 years because 3 years we already used the asset. All right, so that was about illustration 3. Let's quickly see. So the revised carrying amount is 10,000 lakhs. Where was the revised depreciation? Revised depreciation is equal to rupees 1,900 lakhs. So that's it for this lecture, guys. In the next lecture, we'll continue to solve similar questions and then move on to additional topics as well. Thank you. Bye-bye.